Yes, I mean, that's correct. Cash, particularly over the GFC, has actually been quite a good investment, particularly when growth assets weren't performing and people were looking for more stability and also a source of income. However, we should remind ourselves that cash really isn't the appropriate long-term investment. Cash is really there to meet liquidity needs. It can be there to be on a sort of transitional phase between asset classes, and also it can be used for sort of capital stability. But ultimately, you want some growth in your portfolio. Now, as you point out, we have seen term deposit rates decline almost by more than half, but there's still the income needs that people are requiring. And so we need to look at other forms of investments that produce income. And the key to that, from a personal perspective, is the level of risk that an individual within the self-managed super fund is prepared to take to earn that income within their investment portfolio. Yeah, they're various. I mean, from shares, obviously, you are receiving an income in the form of dividend, but also the other benefit is that income is a growing income stream. And so you've got growth in dividends, which really is round about the rate of growth of GDP. What that means is that your income is growing at a real rate of return and not a nominal rate of return. The other benefit from income in shares is what we call the franking credits, which basically means that depending on your marginal tax rate, you get a credit at the end of the year in terms of the tax the company has paid. So it's also quite beneficial for retirees and self-managed super funds. For fixed income, there is an income, but it's a fixed income, and so it's nominal, and you do receive it, however, on a regular basis, and there's greater security in terms of forecasting cash flows because it is a coupon attached to it, and there's also less volatility around that income. The downside to income from shares, of course, is the capital volatility and also the underlying stock. You need to be comfortable that the company you're investing in will be a good investment long term, irrespective of the income flow. Whereas for a fixed income investment, there's much more security of capital. There is the opportunity to earn some capital growth, but that will be very dependent on where you are on the economic cycle. So it is a trade-off between income and the level of risk that, again, investors have to take. But important to note there that the longer term investment horizon for that investor, the reduced risk of shares, because over time that volatility is smoothed out over time. Yes, one trend that I've seen in terms of balance is the old adage in the past when individuals were building portfolios was generally around value versus growth and how to build a balanced portfolio with those components in it. These days, with the growing move towards a preference towards income and the move towards retirement, the balance is more around a diversified portfolio that delivers an income need, but also a growth need. And so I'm seeing more and more people build their portfolio that has a component dedicated to try and meet an income objective, and then another component dedicated to provide that growth objective. And that's not a bad way of looking at it in terms of once you've met your income needs, then ensure that the remaining components of the portfolio have the growth aspect, and you're not necessarily chasing yield, but maintaining growth to maintain a real rate of return in your portfolio and maintain the purchasing power of your investment. I think probably more sustainable than we first envisaged. And if you look around the world and also domestically, we're still in for a period of low interest rates. And having said that, we shouldn't forget that interest rates are a cyclical asset class. In other words, they will move in terms of the economic cycle, and the longer they are sustainable, somewhere down the track, those interest rates will increase. We are in an environment where growth is very benign. We've seen a domestic economy that is in a transition phase from what was a very strong resources boom and resources led to an economy that's now trying to be driven by domestic consumption. And in that environment, obviously, interest rates will need to remain low. The catalyst to ensure that interest rates may reverse and may help savers in terms of income will be the Australian dollar, the housing market, and also the outlook for growth. So growth is benign. The rise in the housing prices will maintain some form of bias towards a low interest rate environment. And what keeping the brake in terms of any moving interest rate is obviously the strong dollar, which also acts as a tightening mechanism within the economy. So I think we should continue to plan for a low interest rate environment, and somewhere down the track that will change, but not in the foreseeable future. Well, I think that's an important question because we are seeing an increase in focus and trend for businesses such as asset management to meet client needs. And it has changed, as I said earlier, from a portfolio that was more around identifying value and growth towards income and growth. So we are looking at products, and the industry is looking at products that tries to meet the needs of a regular income, quite attractive, but also trying to give products that give a greater sense of objective base around what the expectation is and what risk do I need to take to generate that income. There has been a trend towards hybrids, and investors have moved towards hybrids, chasing that yield. And the asset management industry response is, well, maybe there's other ways of providing that yield in addition to hybrids as well. And one of the things we've done is developed a product based on feedback from clients that gives a regular monthly distribution, low volatility, but also announcing that income as a coupon on a monthly basis, very much like a coupon on a monthly basis going forward. And what we've found, particularly if you can also structure that with some franking credits, that is becoming quite attractive for individuals that used to rely on term deposit rates with 6.5% that are no longer available, but the bills still need to be paid and the income is still required. And there's certainly an appetite for increase along the risk curve, but that appetite is limited as people are adjusting to their standard of living based on the capital they have today and not really putting a lot of risk on the table, but prepared to take on some risk to generate that income. I think the confidence for the appetite for risk is greater. During the depth of the GFC, there was a great level of concern, and you saw term deposits being the asset class of choice. And I think that's understandably so. For a period there, equities were in negative return for up to 5 years. And every time you picked up the newspaper, it was all about potential government and debt collapses across Europe, etc. It was only natural that there was a lot of risk aversion during that period. We've certainly seen that turn around over the last 2 years. We've certainly seen the appetite for risk increase, but we have seen a structural change in the attitude. People have recognised that going into 2007, 2008, they probably took too much risk on board. And those lessons have been learned, and so they remain cautious, but at the same time recognise that things have improved and maybe it's a good opportunity to take a bit more risk, but they remain cautious. And the big difference is the focus on preserving capital over time, and whereas previously it was about growing capital to take on higher levels of risk. So there has been a structural change in risk appetite, but more recently we've seen that risk appetite increase along the curve. Look, yield and income is always generated by some form of asset class, whether it be cash, whether it be fixed income, whether it be shares, whether it be hybrids, whether it be other forms of investing. Listed property trusts, for example, are another vehicle that is quite popular in terms of income as they pass the rest of through. Ultimately, when you're chasing that yield, you need to also understand the underlying quality of the asset and the underlying expectations of that asset going forward. If you're chasing yield and income and the underlying asset over time is of poor quality, you will lose out because that will be reflected in the price. And so when chasing yield, understand the risk you're taking in terms of the company you're investing in or the asset class you're investing in. And if it's a company or one type of property, try and diversify that portfolio to attain that yield. Not as important in cash and fixed income to diversify because they're far more generic, far more important to diversify as you go up the risk curve in those underlying asset classes in the attempt to earn a regular income flow.